Welcome to the AAA Storage Podcast, your integrated real estate and development partner exploring all things self-storage investing to bring you diversified success. Let's dive in.
Hello and welcome back to the AAA Storage Podcast. I have with me, as always, the inimitable, the illustrious Paul Bennett, investor extraordinaire. How are you?
I'm great, Brandon. How are you today?
I'm doing all right. This is a fine Wednesday. Today, we are talking about how the fund structure works when investing in self-storage real estate, particularly with the AAA team. And we've been getting a lot of questions from listeners, from potential investors, from current investors. You know, how does it work if I were to invest $200,000, $250,000, $300,000 into this fund? What happens? You know, how does that mechanically take place? What's the structure like? When should I expect returns? You know, those sort of like mechanical, logistical questions. So this may not apply to every listener that might be listening, but it is really helpful to get on the ground. Like, this is how, when you're investing in real estate in general, could be land, could be self-storage, could be multifamily. How does it function? How does it work? But we're going to apply that kind of thinking, particularly to the fund structure that we have set up at AAA. So, Paul, tell me a little bit about the overarching structure of the funds, particularly the Growth Fund 2, and how you guys are kind of putting this together, investing in these properties, and then how does that relate to the actual investors in the fund?
Yeah, Brandon. And this is on my mind. That's why we sort of chose it as a topic today, because we're, as you know, in the beginning stages of raising capital in Fund 2 and working with different groups, but Passive Pockets is one of them. And there are a lot of folks in that universe that don't have a lot of experience investing in passive vehicles. So it's been on my mind because we've gotten lots of questions about how does this really work, and I can tell sometimes by their questions or things they don't understand. First of all, there are lots of ways to invest in real estate. You can invest directly. A lot of people have done that by buying single-family homes and renting them. There are single property syndications. There are fund structures like what we have, where we're raising capital from a larger group of people and investing in multiple properties. And then the other sort of common vehicle is a real estate investment trust, or REIT. And they can be either publicly traded or private REITs. The two in the middle that I mentioned, single property syndications and funds, are the two that are structured most similarly in terms of how they work. So the mechanics that I'm going to go through would really apply broadly to any fund or really any single property syndication that you might invest in, although there may be nuances depending on how a particular structure designs the terms and that type of thing. But let's start with the basic entity structure that you'll find in Growth Fund 2 or that you'd find in any multi-property fund. First of all, there's a fund limited liability company, or LLC. The LLCs are, I say, relatively new. It's a type of corporate entity that really has gained popularity over the last 10 years, and it replaced the old limited partnership structure that, you know, everybody in the industry was used to for years and years and years. In fact, some of that terminology is still survived. Investors in funds are referred to as LPs, or limited partners, in a lot of discussions and conversations. That harkens back to the day when it was actually a different type of entity. It was a literal limited partnership, and there were limited partners and general partners. The LLC is a super flexible entity that was created to replace the subchapter S corporations as pass-through vehicles that everybody used for years. But there is a fund LLC that is the master entity for the fund structure. And then there's a separate fund manager LLC that acts as the legal manager of the fund LLC. Below the fund LLC, each property that the fund invests in is held in a separate special purpose entity, or LLC. And so each property is in its own corporate entity, and each one of those are wholly owned by the fund entity. So that's your basic structure. You've got the fund entity, which is where the capital contributions are made. And then it owns 100% each of the property-based entities that actually holds title to the real estate, operates it, and that provides risk management. It provides lots of things structurally. Principally, it isolates each of the properties from the other, so that if there were to be an issue, a legal issue, you got sued, the property got sued because somebody got injured on site or something happened, they're all separated in different LLCs. So it's really a risk management structure. So that's the basic entity structure. I know without a picture, that's a little bit difficult to see. We may add one after we do this recording if that would be helpful. But that's the basic entity structure or legal structure of a fund, a master fund entity with a separate manager, and then individual LLCs wholly owned by the fund that hold each one of the properties the fund is investing in. And so here's how the whole process progresses. When an investor makes a commitment or invests in a fund like Growth Fund 2, they actually make their contribution to that fund LLC that I talked about just a minute ago. And this is a place where I think some people have gotten confused, but based on the questions that we get. When you invest in that fund LLC, and I'll give you an example. Let's say that you chose to invest $200,000 in Growth Fund 2, and Growth Fund 2 ultimately raised a total of $10 million in capital. Growth Fund 2 is projected to be much larger than that, but I'm trying to keep the number simple for the example. So a $200,000 investment in a $10 million fund, you've invested 2% of the total capital in that fund. And therefore, you own 2% of that fund LLC, and indirectly 2% of each one of the SPEs that are wholly owned by the fund. So your pro rata ownership in the fund and your pro rata benefit from your investment in the fund is simply based on the percentage of the capital that you contributed, the equity capital that you contributed to the fund. And sometimes I think people aren't quite clear on how that works. It's really pretty straightforward. So you invest in the fund. In this example, you have a 2% ownership in the fund because you invested $200,000 in a $10 million fund. The next thing that happens as a sponsor is we have to do what's called capital allocation. There are two levels that capital has to be allocated. At the fund entity level, it has to have the capital it needs to pay all the expenses it is going to have as a fund. And that would range from the management fee that's paid to the sponsor, the administrative fee that's paid to the fund administrator, which in our case is IQEQ, one of the largest fund administrators on the globe. There are legal costs, both for formation and some legal cost ongoing. There's annual tax costs and annual audit costs because our funds are all audited by Cherry Beckert and Holland. So you have to project and plan for the expenses that are going to occur at the fund level. The next allocation of capital is to the investments themselves. If you think about each one of those LLCs that are owned by the fund is going to hold an investment. All of the underwriting that we do, all of the pro formas that we build, both in terms of construction cost and working capital those projects need to get through the lease-up period before they begin to generate cash flow, has to be accounted for and allocated to each one of those entities. And it's sort of It's a little bit backwards math, and we apply it as we go through the allocation process through the life of the fund. Ultimately, how many properties we can develop is determined on how much capital we raise. So as we progress through the capital raise, we release projects into the fund and they become active and they get funded, but we certainly can't take on a project until we know we've got the committed capital to fully fund it. Not only the construction, but also the working capital that's needed to get it through lease up and stabilization. So that kind of gives you a look at the legal structure, and then the first two big steps in the process. The first is the contribution of capital and what kind of ownership does that represent, and then secondly, how do we plan when we say Growth Fund 2 is going to be a $40 million fund, is going to build or develop 11 properties. How did we arrive at those numbers? Well, we did it because we built the expense budget for the fund. we built the construction budgets and working capital needs for each of the properties, and we add those all together and say, okay, to do all of that, we need $40 million in capital. So that's sort of how we arrive at the fund size at the end of the day. We do have the right to go to $60 million in total capital in Fund 2 if we exceed 40 and get to 60 or anywhere in between. We'll add some properties to the fund portfolio, so we'll increase the diversification that our investors get. And of course, on the other side, if for whatever reason we have difficulty raising, $40 million and we wind up raising $30 million, then we'll pare the portfolio and the fund down just a little bit, because we have to make sure that the amount of capital we have matches, the development and construction work that we take on in the fund. So that gives you a quick look at sort of the first 2 or 3 pieces of the puzzle. Okay. From there, you go into the operational phase. And when we start a project, we use construction financing, as almost every developer does, and that is typically 65 to 70% of the total construction cost for a project. The other 35% or so is the equity that's invested by the fund in that project. And the equity always has to go in first. So the first application of that equity is the fund actually purchases the land from an affiliate of ours, and the bank allows that to be counted as part of its equity investment in the project. And then the fund will with the equity that it has, contribute that equity to cover the initial part of the construction cost. Once we get to that 35% level, at that point, we can then begin to draw on the loans from the bank to pay the remaining portion of the construction cost through the life of the project. And so that's sort of the first deployment. All of the equity is really deployed in an individual project very early, over the first 90 to 120 days at the most. All the equity's in a project, and from there through the rest of construction, we're simply drawing on construction loans with the bank in order to fund the rest of the construction. Once we complete construction, the project goes into lease up, and that's when the next component of equity is likely to be needed, because when you open the doors on day one, you have interest cost with the bank. Our construction loans are predominantly interest only for about 30 months from the point that we start drawing down on the loan. But you have interest costs to pay, and you have operating expenses. You have a manager on site, you have utility bills, you have property taxes, and you have no revenue on day one. So the fund has to have working capital to fund those expenses, usually for a period of 6 to 12 months in the beginning of the lease up of a project. And so that's where the second piece of the fund's investment comes, is that working capital that it takes to get a project through the initial lease up. We do build in phases. And so once we get through the initial lease up of phase 1, we get it to about 70% occupancy. We'll then build phase 2 of the project. But in most instances, because of the equity that has already been invested by the fund, and because the property has increased in value, because it's now generating cash flow, there's sufficient imputed equity in the phase 1 result that we can lever the phase 2 construction 100% with a lender and don't have to put any more equity. There are some occasions where it requires a little bit of additional equity to build phase 2, but generally we can do that with 100% construction financing. At that point, we're simply head down. Marketing's focused on driving traffic and driving new tenants into that facility, because we're then on a run to get the property to full stabilization. And that's the point when we get it to about 75 to 80% occupancy, where it's generating sufficient net cash flow to cover all of the debt service, and then begins to generate excess cash flow that can be distributed to the investors. As you know, in Growth Fund 2, our strategy is to sell properties at that point. We don't really anticipate having cash flows from distribution if we are successful selling them at stabilization, because that's exactly the point that they begin to generate excess cash. But if you were going to hold that property ongoing, that's the point at which you'd have excess cash to distribute to the investors. The next step in the process is the exit, and that's the thing that we get excited about, and certainly our investors get excited about, and that's the sale of the property to a third party. And at that point, we're distributing those proceeds back to the investor, which leads me to the next piece of the puzzle, which is the application of the waterfall or the distribution structure in our fund and to some degree in all funds. But I'll stop right there, Brandon. I covered a lot of material, and just see if there are any questions, any cleanup, because then I'm going to walk through. This is probably where we get as many questions or people who don't quite fully understand how it works is at the distribution point, that waterfall, how's it applied, how does it affect them, how does it affect their returns, those types of things. So,
yeah, I'm glad we're stopping here because A, you covered a lot of material. B, I'm very glad that experts like you are doing this because it sounds very complicated. And especially as a novice investor, I have an MBA, I know some of this financial stuff, but to hear you talk about the logistics, the mechanics, like how it actually happens from, capital to construction and beyond, it's very helpful to hear you lay that out. But yeah, I am curious, okay, now what happens? How do I get my money back? Let's say I, invest $200,000. How do I get money back? What does that look like? Because I understand this is not a income strategy. This is an equity strategy, which means later on down the line, years from now, you will likely see money.
Yeah.
It's not an immediate thing.
Yeah.
So I'm curious how that kind of takes place. Like, when do I actually get money back into my bank account? That's what I'm interested in.
That's what everybody does this for, right? That's the whole point of the process. I will clarify time frame a little bit. You said years down the road, and in most cases that's accurate, but I don't want to leave people with the wrong impression. It takes us about between 4 and 5 years from the first shovel of dirt to the point where we generally expect to be stabilized and ready to sell a property. And so in Growth Fund 2 with 11 properties, we're not going to start them all on day one. So you're not going to have all your money back by year 4 or year 5. However, you will begin to get your money back by year 4 or 5, and it will come back as each sale occurs between year 4, 5, and year 7, 8 is sort of our target range. Because we stagger the starts over the first couple of years of the fund. We really like to liquidate a portfolio within 6, maybe 7, but we sort of use that 6 to 8 year time frame as the expectation for an investor to get all of their return back from Growth Fund 2. But let's talk about the waterfall, because I think the first thing people don't understand about the waterfall, first of all, there are 2 types of waterfall in a fund structure like ours. There are waterfalls that are applied on a global basis across the entire portfolio, where the cash is only distributed when the last property is sold. That's called an American waterfall. And then there is what's termed the European waterfall, which is where you actually distribute cash and apply the waterfall to each property as it sells. That's the structure that we have. We think it's important to return that capital and the profit on each project back to our investors, at the sale of the property. So we don't hold that cash to the end. We don't have the right to reinvest that cash or do other things with it. It's distributed to the investors as each property sold. I'll go down this rabbit trail briefly. Ours is actually a combination of the two. We distribute all cash at the time the property is sold and apply the waterfall to that property. However, that leaves theoretically the possibility that we would either get more or less, or the investors would get more or less than they should, because the performance of each of the investments could be different, and therefore the application of the waterfall comes out different. So as a protection for investors, we have what's called a catch-up. When the last property is sold, The calculation is done to apply the waterfall to the entire portfolio. And if doing it individually throughout the years as each property was sold resulted in a distortion of the distributions, we have to give money back to the fund to even everything up. The example would be, I probably shouldn't have gone down this rabbit hole, but it's actually a really positive thing for the investors. I'll give you an example. We sell a property, it does great. It goes through the waterfall, and because it's done fantastically as the sponsor, our 30% of the fourth step in the waterfall is a significant amount of money. Great benefit for us. The next property is sold and it didn't do very well. The investors got their money back, but they didn't even get all their preferred return. The catch up at the end evens all of that up to make sure that we aren't over-rewarded for the project that did well and the investors weren't under-rewarded for the project that didn't perform as well. So that catch-up at the end really makes it, at the end of the day, it functions like an American waterfall where everything is calculated after all the properties are sold. But it provides the investors with a chance to get their return as each property sold, so they get it a little bit faster. Again, probably a mistake to go there because I probably confused more people than I've helped understand. But anyway, let's talk about the waterfall.
That's fascinating.
The first thing people don't understand about the waterfall is it is applied to every dollar that is ever distributed out of the fund. So just for example, the waterfall doesn't just apply to the sale. The first step in the waterfall is that the investors get 100% of any distribution until they receive a complete return of their invested capital. So remember that we are applying the waterfall on a property by property basis. So let's just take one property. Property A, we get it built, it leases up, things are great, but for whatever reason, we decide that it's not the optimal time to sell that property. So we hold it, and we're actually going to distribute cash flow to the investors. The investors are going to get every dollar of that distribution until they've received 100% of the capital that the fund invested in that project. So we're not sharing in cash flow distributions unless the investors have gotten all of their capital back and their 7% preferred return. Not very likely as you hold a property that, assuming a 6 or 7 or 8% cash on cash return, it would take 12 years of those distributions before the investors had received all of their capital back. So the first step in the waterfall is any dollar that comes out of the fund, out of a property, it will come out of the property through the fund vehicle to the investor, but it's really measured based on the individual property. So the fund has $2 million invested in this property. It starts generating cash. 100% of that cash is going to the investors until we've given the investors the $2 million that was invested in it. Does that make sense? Am I being clear enough there? Am I being confusing?
Yeah, no, it's helpful.
The second step in the waterfall is our investors get a 7% preferred return. This also confuses people. As we've said, I just used a cash flow distribution, but we really don't anticipate distributing cash out of Growth Fund 2 or Growth Fund 1 because they're designed to sell the properties at the point they actually begin to generate any excess cash flow. And so in addition to getting their capital back, once they get their capital back, 100% of all the proceeds then go to the investor until they get a total of 7% per annum from the day the capital was invested in that property until the day they get their money back. So they get all their money back plus a 7% return annually before, as a sponsor, we ever get anything. But that is not a 7% preferred return that's paid on a quarterly basis or on a annual basis. It really accrues until the property is sold and then it's calculated and it's a preferential distribution to the investors. The third step in the waterfall is we get to catch up. We get 30% of the amount that was paid to the investors in the preferred return. So we are essentially going to get 30% of that pref distribution that was made to them. So now we're on equal footing. They've gotten their capital back. They've gotten their 7% return on an annualized basis as a preferred return. We then get 30% of that preferred return as the sponsor. And at that point, we're on equal footing. And the fourth step in the waterfall is that everything beyond that is distributed goes 70% to the investors and 30% to us as the sponsor. And that's basically what I term profit sharing. It's our incentive compensation to make our investors a lot of money. If we simply return the capital to them and give them a 7% annual return, we get nothing, and they're probably not happy either. But we haven't done a great job, and therefore we haven't earned any incentive compensation. Once you get the return of capital, the preferred return back to the investors, we get a small catch-up. It would roughly be what's 30% of 7, 1.4, the 2.1% maybe of the capital invested in the project in that third step of the waterfall. And then it's only when we get to the fourth step, which is really where we're sharing the profits over and above the capital and that was invested in the preferred return, where we have any benefit at all. And that structure is pretty common. There are different variations on it, more complicated variations in some cases, but that's essentially the waterfall structure, and that's applied to each property when it's sold in the life of the fund. So that will happen 11 times in Fund 2 as we sell all 11 properties.
This is so great that you have, there's so much like governance and accountability between, the incentives, like you said, that everything's aligned, that you guys put skin in the game. You make sure that investors are made whole. And then you guys can, what you say, profit share after that to make sure that there's, that everybody's getting what they deserve. But not only that, what I think is interesting is also that you're careful and conservative, if I may say that, where you make sure that you have the capital available to invest in those, to construct the properties to begin with. And so there's so much thoughtfulness. I think that's what I'm taking away from this, is that you guys really think through, like, how can we do this really well, do it, like conservatively, but also take advantage of the growth outcomes of each investment years later, which I think is really awesome.
Yeah, well, the whole structure is really meant to, it's meant to do several things. For investors, it's meant to allow them to combine their capital with other like-minded investors, to do projects, to invest in things that they otherwise couldn't do on their own. It's also designed to give them a sponsor who has expertise and experience that increases the likelihood of success. Obviously, if you've never, owned or bought or developed a self-storage facility, doing that on your own would be a pretty scary exercise. So it allows them to invest in assets that they don't necessarily have a lot of knowledge on. As a sponsor, it provides us with the opportunity. Well, a couple things. I've said this before. We've been the largest investor in every syndication we've ever done for 33 years. Our business started because we believe in, and want to develop and own self-storage facilities and office industrial flex facilities. We brought investors into what we do in order to allow us to do more of it, more than we could do with our own capital. But we invest alongside. We are an investor in Fund 2. We are an investor in Fund 1. We will be an investor in Fund 2. So we're not only on the 30% side of that as a sponsor. We're on the 70% side of that, going through that waterfall as a limited partner or as an LP or a member in the LLC, just like our investors. And I don't think there's any doubt. I hope it's not the case, because I'll be super pleased if it is. But I would be willing to bet you $1 to the hole from a donut we'll be the largest investor in Fund 2. Right now, we're sort of doing some internal planning, but it looks like we'll invest between $6 and $8 million of our own capital in Fund 2, and so we'll be the largest single investor in the fund. But the whole structure is meant to provide benefit to both the investors and the sponsor. If we do a great job, that we get the opportunity to earn incentive compensation because we've given our investors, extraordinary returns.
Yeah, that's amazing. So there's a lot of, technical details that goes in with this kind of structure and how you guys allocate capital and all of that. Presumably, I know you guys are, as I mentioned, very careful and thoughtful in the way that you're not only designing the fund, but also communicating with investors. So if there are folks that are listening, looking to get invested in the fund, you will provide, materials that will kind of outline how this works and all that sort of thing. Because some investors that you've had are very sophisticated, know exactly what, all this, how this works, have done this before. Well, there's some folks that might be new to this, and that, you guys will help them along the way to kind of figure some of this stuff out.
I feel like I've done a bit of a poor job. I had in my head, it's always the way with me, right? I have Michelangelo pictures in my mind, and then when I pick up the pen and start drawing, stick people come out. So I feel like I did a poor job trying to walk people through this, but and everything I just went through is described in very legal language in the fund's prospectus, but also in the limited liability company agreement. That's a part of the package every investor needs to review. But unless you went to law school, the LLC agreement may as well be Greek. So we're always more than happy to help people walk through it and try to understand how this really works. But I think at the end of the day, the thing that investors need to focus on is that any sponsor is going to have the opportunity to benefit if they do a good job. But the structure is such that you're going to get all your money back plus at least a modest return before the sponsor has a chance to earn anything. And that's certainly the approach we take. I'll point out one other thing. You mentioned capital allocation. There are sponsors out there that are simply capital allocators. They raise capital from investors with a strategy, and they invest that capital with an operator who's either buying a facility, developing a facility, or whatever. They're not the operator. They're just capital allocators. I think it's important. I think it's a better situation is to invest in somebody who's doing both. And at AAA Storage, we certainly manage the fund, and we do the capital allocation, and we manage that whole process and the waterfall and everything that goes with it. But what we really are is a real estate developer and property manager. That's our DNA. That's who we really are. We've added the capital allocation and fund management capability because it was necessary. But at our core, we're self-storage and office industrial flex developers, owners and property managers and investors. That's who we really are.
I love that. I think it's so important to note that this is the way that you have operated for so long. It's in your DNA. And so you approach it differently than you would like a pure, finance firm or, family office or something like that. So I think it's really neat how you guys have that kind of embedded, like integrated nature. I think it's cool.
Yeah, we're not financial alchemists.
Well, any final thoughts on that?
No. I was just going to say we are not financial alchemists. We are muddy boot developers, and I think that's a good thing. So
awesome. Well, Paul, thank you so much. I do think like a graphic or something might really help, just to kind of like visualize it really clearly, get the kind of the lay of the land. And so we'll see if maybe there's something we can work on to help investors think through, like, okay, how does the structure? And then when you go and read that documentation, it's a lot more clear in that way. So Paul, thank you. This is really, really helpful because again, it's hard to see like, okay, if I put my money here, how does it work? How does it get back to me? And is this something that I should invest in or should think about? And so the way that you've kind of laid it out, not only tells the mechanics, but like you said, the value and the design of it is really neat. So thanks for sharing all that. And we will see you next time right here on the show. Thanks,
It's
Paul.
always fun, my friend.